All right, today we are pulling back the curtain on one of the most powerful and, let's be honest, controversial tools in global finance: transfer pricing. This is the engine that lets the world's biggest companies legally shuffle trillions of dollars in profits between countries, often to shave down their tax bills. So, let's get right into it. To really get a sense of the scale here, let's just start with a number: $3.5 billion. You know what that is? That's the minimum estimated value that's been lost to shady transfer pricing, and that's just for African diamonds from Angola and the DRC. We're talking about one industry in just two countries. This is a global game, and the stakes are absolutely massive. So here's how we're going to break it all down. First, we'll look at the problem itself, the billion-dollar shell game. Then we'll talk about the main rule designed to stop it, the arm's length principle. From there, we'll see how modern business makes things tricky, how you're supposed to split up the profits fairly, the huge new global rules trying to fix everything, and finally, the wild tech arms race that this is all kicked off. Okay, section 1. Look, before we can even talk about the solutions, we first have to get our heads around exactly how this whole game is played. It's all about one thing: controlling the price of stuff that's sold between different parts of the very same company. This right here is the classic playbook. So you have a parent company, say in the US, that makes something. Now, instead of selling it straight to a customer, they first sell it to their own subsidiary, which just happens to be located in a country with super low taxes. And here's the trick: they sell it for an artificially low price. Then, that foreign subsidiary turns around and sells the exact same thing to the final customer for the real, much higher market price. And poof, just like that, most of the profit is magically parked in that low-tax country, while the country where all the real value is created, well, it sees hardly any tax revenue from it. And the real-world impact of this is just staggering. The African Union estimates that something like 60% of all capital flight from the entire continent is a direct result of improper transfer pricing. We're talking hundreds of billions of dollars that could have gone into development, just moved offshore. So how on earth are governments supposed to stop this? Well, that brings us to our second section, and the absolute cornerstone of this whole system: the arm's length principle. This is the international gold standard for fairness. You know, the core idea is actually pretty simple. The arm's length principle basically says that companies that are part of the same family have to act like total strangers in the marketplace. The price they charge each other must be the same price that two completely independent companies would agree on. In other words, you're not allowed to give your own subsidiary a special family discount when the tax authorities are watching. And this really lays it out perfectly. On the left, you've got your controlled transaction inside the corporate family, where the price can be tweaked and nudged to help with the company's overall tax strategy. And on the right, you have an arm's length transaction, where the price is just the price. It's set by the market. The entire goal of tax authorities everywhere is to force those transactions on the left to behave exactly like the ones on the right. But, here's where things start to get really messy. In our modern economy, we're not just selling widgets anymore. Value comes from intangible things like brands, patents, software. And figuring out a fair market price for an idea, that's not so simple. So the big question becomes, who really creates the value? Let's see how they try to figure that out. This right here, this is the heart of almost every major modern tax dispute. It's the battle between legal ownership and economic ownership. Sure, a shell company in a tax haven might legally own a famous trademark on paper, but who's actually doing all the work, the marketing, the research, the development that makes that brand valuable in the first place? That's the economic owner, and that's where tax authorities argue the profit really belongs. So to cut through all that legal fog, tax authorities now use this framework with the kind of clunky acronym DMPE. The best way to think about it is like a detective's checklist. It helps them figure out where the real economic action is happening. It doesn't care who owns the patent on paper. It cares about who's doing the work to make it worth something. And here are the 5 key functions. They ask, who is developing the new technology? Who's enhancing the brand with marketing? Who is maintaining it, protecting the patents? And, crucially, who is actually exploiting the whole thing to make money? If you can map out who's doing what, you can find where the real value is being created. Okay, so once you use a tool like DEMPE to figure out who's actually creating the value, the next big question is, how do you split the profits fairly between all these different parts of the company? This is where things can get really, really technical. So for the most complicated cases, the go-to tool is called the profit split method, or PSM. Now, I know this flowchart looks a little intimidating, but the core idea is pretty straightforward. You use this method when a company's business is so tangled up across different countries that you can't possibly treat each office as a separate thing. Think of a big tech company where the R&D in one country is completely inseparable from the marketing in another. In those cases, you have no choice but to take the total profit and just split it. And once you decide to split the profit, there are basically two ways to do it. The first one is called contribution analysis. You pretty much just divide the profits based on how much value each part of the company brought to the table. Simple enough. The second, more complicated way is residual analysis. With this one, you first pay each part of the company a basic routine profit for its everyday functions. Then you take whatever's left over, the residual profit, and you split that based on who made those really unique, hard-to-value contributions that led to the big win. Let's make this really simple. Imagine a parent company spends, say, $15 million on global advertising. At the same time, its local branch in another country spends $10 million on really targeted local marketing. Well, if you look at their spending, that's a 60-40 split, right? So it would be pretty reasonable to split the final profits using that same 60-40 ratio. Now, all of this complexity and all these disputes have led to this massive global effort, led by the OECD, to basically hit the reset button on the entire international tax rulebook. Seriously, this is the biggest change in a century, and it is happening right now. And this whole new system is built on two pillars. It's super important to know the difference. Pillar 1 is all about where taxes get paid. It's designed to shift some of the profits to the countries where a company's actual customers live. Pillar 2 is about how much tax gets paid. It creates a global minimum tax rate to stop that race to the bottom, where countries keep cutting taxes to attract companies. And Pillar 1 is aimed squarely at the biggest of the big. It only targets multinational companies with global revenues over 20 billion euros. We're talking about the giants of the global economy. And here's the magic number for Pillar 2. It establishes a groundbreaking global minimum effective corporate tax rate of 15%. What that means is if a company pays, say, 5% tax in a tax haven, its home country can step in and tax them on the other 10% to top it up to 15%. And that brings us to our final section, because all of these new, incredibly complicated rules have sparked a massive new compliance industry, and with it, a full-blown technological arms race between companies and tax authorities. The big multinationals now have to deal with this three-tier documentation monster. They need a master file that's like a global blueprint of their business, then a local file for every single country they're in, and on top of that, a country-by-country report that just lays it all out, where they make money and where they pay taxes all over the world. It is a new era of radical transparency. And this slide really says it all. You can see companies aren't just using Excel for this anymore. We're talking about sophisticated software platforms, often powered by AI, built just to manage, document, and defend their transfer pricing. It just goes to show you that compliance isn't about paperwork anymore. It's a high-tech battlefield. So at the end of the day, we're left with this question. We have new global rules, we have a powerful AI on both sides of the table, and we have levels of transparency that were basically unimaginable just a decade ago. So is this finally the end of the road for the classic tax haven shell game? Or is this just the beginning of a brand new, even more complicated game between global companies and the countries that want to tax them?